2% due to increased licensing fees as the business went onto the cloud during the year. In terms of our office costs, most of our office costs are derived from consumables, which again faced increased pressure due to high inflation rates. Our group shared services have declined as the group continues to take a look at their cost containment measures as well as group optimization. In terms of our employee-related costs, these have increased by 9% due to salary adjustments in order to cushion our staff members in the final quarter of 2018. We believe in human capital is a very important asset for us. Our key performance indicators. Once again, to reiterate, we are now sitting at an occupancy level of 76%. This is up from 70% same time last year. Our rental yields have gone up, as well as our average rental per square meter. In terms of our admin costs to total income percentages, we now sit at 44%, up from 37% same time last year. Our total costs as a percentage of our total income are currently sitting at 69%, up from 54%. Again, this is where we can see how much of our cost lines have been driven by inflation and where we stand today. Taking a look at the statement of financial position. At the beginning of the year, at the closing of the year, First Mutual Properties closed off at $146 million worth of investment property. This is 6% up from the same time last year. I'll take you through a reconciliation of that in a further slide. In terms of our current assets, there's been a decline of 62% from $5 million to 2.2. This is an indication of the amount of cash that's been utilized both from the acquisition, both to support our acquisitions and developments, as well as our investment strategies. For 2018, First Mutual Property closed off at a total assets of 149.3 million, up from 144.5. Looking at our non-current liabilities, there's been a movement of about $3 million, coming up from 16.7 million to 13.2. That movement is largely due to the deferred tax on the fair value gain of 6.3 million that we have seen coming through in 2018. In terms of our current liabilities, these have also decreased as the business endeavors to ensure that our suppliers are paid timeously so as not to compromise on service or product. I shall now take you through the investment property reconciliation. At the start of the year, First Mutual Properties began, the portfolio opened at a value of $137 million. Throughout the year, we acquired 2 properties, namely One Dairy and Chibu Supermarket. We've put through improvements to our existing properties of $300,000, and we have seen a fair value adjustment of $6.3 million. This has brought us to a closing balance of $146.1 million for the year ended 31 December 2018. In terms of our cash flow, our cash generated from operations for the business sat at $3.8 million, which is up from the same time last year, 2.023. Throughout the year, we've managed to utilize our cash as follows. We've paid off 2.3 million to our investing activities, as well as paying off financing activities. In terms of the closure of the year, as at the end of 31 December 2018, our cash and cash equivalents sat at just above $600,000. On the back of the 2018 performance, the board has resolved to declare a final dividend of 730,000 RTGS dollars from the profits of 31 December 2018. I shall now hand over to Kuda to take us through the strategic focus and outlook. Thank you.
Thank you very much, Tendai. I got it right this time. This is the last slide of our presentation. We will share with you our view of the property sector just going forward. Our view is that the property market, due to the nature of our economy, basically characterized by, from a property perspective, huge supply of space, we think it will remain an occupier's market. Then in terms of rental growth, the market, property market players are trying to respond to the announcement of 22 February or 20 February in terms of the exchange rate and how it impacts on rentals and value. So there are negotiations which are taking in terms of renegotiating rentals. We think in the short term, not much may be achieved, but in the medium to long term, property players will be able to realize some value in terms of rental coming through their property assets. Then from a development activity, we think that the market will continue to be dominated by, not dominated, rather there will be very little activity, mainly due to lack of vital foreign currency component, which is a big input in terms of construction. Generally, when you assess construction projects, between 30 to 40% of your elements, that is your electricals, your plumbing, your aluminium, and so forth, is generally imported. So depending on the capability of a particular institutional investor to fund those obligations, it will certainly impact hugely in terms of development capacity of players. And lastly, due to the huge urbanization which continue to characterize our urban centers, residential development will continue to be dominant. There will be a very strong demand. Harare City Council and other local authorities continue to record very high numbers in terms of the waiting list. So that is a feature which we think will continue to obtain. So in terms of business priorities linked to what we shared with you earlier on, just in terms of the market overview, we think that to address some of the issues, especially aging buildings, there may be need, you want to look at the performance of particular buildings, identify non-performing assets, capital recycle, and reallocate capital to other opportunities which are demonstrating sustainable demand and profitability. Then we are also going to have a focus within our strategy of sustainable solutions. We think that we need to make a contribution in terms of waste management and renewable energy. So we will be partnering, or we've already started discussions with some of our big tenants just to ensure that there is a contribution to waste management solutions which are currently being promoted by EMA and other related parties. Then in terms of product offering, we also feel that there are opportunities abundant, though the economy may look the way it is looking, but we certainly believe that there are opportunities for those who continue to look in the right direction. We'll continue to focus on office park and also retail products. We'll also be looking at leisure assets. We'll also be looking at students' accommodation, which we are already engaged with other players. Then finally, realizing the inflationary cost pressures which are around in this particular environment, we're going to continue to have a sharper focus. We'll look at every cost item with a sharpened pencil and ensure that there's cost optimization. Thank you very much, ladies and gentlemen, for your listening. I'll now hand over to Farai for moderation of the discussion. Thank you very much.
Thanks for getting it right, Kuda. I would just like to acknowledge the presence of the Chairman for First Mutual Properties, Mr. Moyo. Welcome. At this stage, we will take questions. If you could just identify yourself once you get the microphone before you ask your questions. Thank you. There'll be someone going around with a roving microphone.
My name is Marvin Jizonga from Comaton. Just wanted to ask what percentage of your total rental income is coming in as hard US dollars, and conversely, what percentage of your total operational expenses are denominated in hard currency?
Sorry. In terms of our revenue, 16% of our revenue is in USD. In terms of our expenses, what we've tried to do is to maintain 100% of that in RTGS. The onus is on the supplier to give us an RTGS amount. In terms of what we think it could be, in terms of the components, we suspect between 25 to 35% is actual foreign currency.
My name is Tafara from Morgan & Company. My question relates to your investments and the properties. What we've seen in the industry is investment companies going into tourist destinations like Big Falls and investing properties in those sectors. Are you also looking to invest into properties that are in prime tourist destinations in Zimbabwe?
Thank you very much, Tafara. The last slide that I spoke through actually mentioned that one of our business priorities is to look in the direction of other investments which we have not been invested in, and one of the direction which we are actually looking at is to be in leisure assets. So you are right, we are looking in the direction of Victoria Falls, if I may be specific.
Hi, my name is Brian from Ernst & Young. My question is in regards to your 7% increase in occupancy rates. What I wanted to find out is, are you guys negotiating your new occupants in US dollar terms or in RTGS? And the ones that are already there, what measures are you taking to renegotiate these so that they're in line with the overall macroeconomic environment?
Thank you very much, Brian. The results that we have reported, obviously you would know they are 31 December 2018. So in terms of the negotiations that we were doing in 2018, you actually find a mixture coming out of that. I think the very first question was asking a question about what component of rent is actually net currency. So in 2018, we did have new tenants coming through into our portfolio, some coming through paying hard currency, and also others coming through paying RTGS rentals. Then the other part of the question is, what is the business doing about adjustments of rentals? I indicated earlier on in my presentation that after the 20 February monetary policy statement, then followed through by the instrument SI 33 of 2019, property players actually trying to, we are already re-looking at all our rentals. So we are in the middle of negotiations. And obviously what we are trying to do is to, for all intents and purposes, for one to be able to say I'm over the hurdle, one looks at the inflation rate as a benchmark and as a reference point. So what we have done is we have looked at the current rentals. We are also looking at the specific sectors themselves. Because what you also want to do is, when you are engaging your tenants, you are not going just to approach all the tenants, be they in retail, industrial, and office park, and CBD offices, with all the same proposals. You have to take into cognizance their circumstances and their ability to pay rentals. But in short, the business has embarked on rental negotiations which are meant to preserve value for the investors. Thank you.
Okay. Do we have any more questions? Young lady over there.
My name is Ivonia from Imara. Do you think it's prudent to pay a dividend in view of the constrained cash flows and the funding requirements for the project pipeline?
We've done a good assessment of where we stand in the market. We believe it's prudent, and our cash flows support the payment of that dividend. In terms of the funding requirements that we require, we're more than confident that we will be able to quickly access them at any stage.
My name is Mbati. Could you further elaborate, given the dividend payment, given the adverse opinion that was expressed by the auditors, how sustainable is and how appropriate was the dividend payment though?
Okay, just to clarify, the adverse opinion arose due to the irregularity between the legality and the IFRS statements. It's market-wide, so you'll notice that most listed entities will have that opinion. The opinion itself does not speak to the business operations and the cash flow abilities of the business. It's simply that the contradiction between IFRS itself and how you're meant to report it, and the law of the land, which has asked us to report in a different way. Secondly, the appropriateness of the dividend. The dividend will be declared in the RTGS dollar. I indicated the cash generated for the year 2018, which was sitting at just about $3 million. We are more than confident, and we are more than excited, I think, at the prospect of 2019, that we will be generating even more cash in the periods to come. So we do feel that the dividend is at the very least prudent at this stage.
My name is Simba. I just wanted to inquire regarding your project proposals. I think, do you have timelines for some of these projects? Because at one stage there was talk of 4th Street project, now it's Arundel Office Park expansion, then there's also talk of university accommodation. Is there a timeline? You also said that you are very confident of your funding position. So is there an actual project that you are aggressively pursuing, and do you have timelines for that?
Thank you very much, Simbarashe. Yes, there are timelines to our projects. Let me mention that SV Muzenda, yes, was brought to the knowledge of the market, and it had actually progressed to almost implementation stage. But what then happened is that on further review, due to the changes in the macroeconomic environment, there was actually need to look at the scope of the works. Being a joint venture arrangement, when you review a project with another partner, there is need to have an agreement. So unfortunately, the discussions continued to drag on, and our decision then was, we are not going to continue to wait and say Simon Muzenda remains, and we continue to bring it to you and just explain and say we are still waiting to have an agreement in terms of the implementation framework. So we found it prudent to actually say, what is it that we can do better? We have got a land bank. We indicated that we've got 24 hectares at Arundel Office Park. So yes, there are time frames to the project. What we have done is, before we make an announcement to the market in terms of the actual timetable, we said we have recruited a project team. They are the experts who are going to help us structure, cost the project, and relate it to how we are going to do things. So that is essentially the thinking there, that it has been deliberate that we could not say to you we are going to break ground in Q 2019 for lack of detail. And also we need to operate. We learned some lessons from SV Muzenda, that prior to you bringing a project to the market, there are certain things that you need to have in place. So now the project team that we've recruited for this particular project are going to give us detailed information. Once that is actually on hand, we take it through our board and then we'll bring it to the market. Thank you very much.
Sorry, is it the same issue with the universities as well, university accommodation?
May I restate myself? The student accommodation was not a project that was announced. This is actually what I said. I said in terms of new product offering to reposition and diversify the portfolio, we are also going to be looking at other opportunities within the market, and that will include, actually specifically said, leisure assets and also student accommodation. So it is a direction that we are looking towards. It's not yet a project. We are only sharing with you an outlook and where we think the space that we can play.
It's quite huge, $6 million in US dollars, given the performance of your properties. And I'm not seeing anything that speaks to the differences in the sectors you are playing in. Maybe if the CBD office had such a negative fair valuation, it would make your numbers believable.
I didn't get the name, but thank you very much for the question. There's a slide which we shared which explains the movement in the respective sectors. And maybe first of all, let me say that I am not the valuer. This was an independent valuation by Knight Frank. After they presented the results, or rather their opinion to us, we engaged them to understand more as to the outcome of their valuation. We even sought to understand that whether the methods they actually used in this valuation were the best, given the various macroeconomic uncertainties. We even pushed them whether it was not necessary to look at other alternatives, valuation methodologies, and so forth and so forth. Be that as it may, we were presented with information which we analyzed, and after discussion with them, this is what we understood from what they explained to us, that the value drivers in terms of the fair value gain were mainly coming out of the two components. That is residential. We have got significant residential investment at George Square Mills and also at Fofa Gardens, some apartments in Avondale. If you look at what we showed up on the presentation, residential accounted for 27% in terms of the uplift of the valuation. Then I also explained about land, that the market is suffering from lack of suitable, serviced and well-positioned land stock. And in terms of the analysis and assessment done by our valuers and the movement that actually happened, land which accounts for 17% of the value of our portfolio, yet a movement upwards of 20%. And also suburban retail, also yet a movement of about 5%. And one of the things that I earlier on explained was that we had a movement in terms of the top line, that is revenue. Our rent income had an uplift of 9%, mainly accounted by turnover. So what you then see is that that turnover feeds through to your valuation in the valuation. So that is how the valuer explained themselves And in our discussions, and after the questions have been explained, we thought it was a reasonable explanation, but that is how the portfolio was looked at. Thank you.
How generous you are in terms of accepting the upward fair value adjustments. And in a sector that is suffering, I don't see that prudence in terms of taking an expected knock, especially on CBD offices. So then it makes the aggregate number questionable, because it's not showing that what you are applying to the sectors that are doing well, you are also applying it to the sector that is suffering.
Thank you, Ranga. Now your voice has made me know your name. You raise an issue of us accepting the valuation. I think the most important thing that we as management and also reporting to the board we took into account, it was that we have got a valuation which was carried out under an environment which can be characterized as highly uncertain. And when you are carrying out a valuation which is generally characterized by high uncertainty, you do question how the valuation has been done. But if an explanation has been given and justified, you will not continue to insist and say, I'm actually going to reject the valuation. We got even to the extent of actually saying, I earlier on said, were there no other methodologies which could be applied to explain the valuation or to come up with a valuation? And there are alternatives which could have been taken into account, that is like discounted cash flow. But again, for lack of certainty of inputs which go into evaluation when you are doing a DCF, when you are running your 5 years, when you are running leases, and you then have another perpetuity, you then have got a dilemma, because already our current leases are not running as long as 5 years. Very few. Most of the leases that we currently have in the market are between 1 and 2 years, because most property owners are taking a very short-term position in terms of wanting to have that ability to revert and review. So that is our explanation. Thank you.
Do we have any more questions? If we don't, thank you very much for paying attention. We're going to have a 15-minute comfort break, so if you could go to the room behind you and have some refreshments, and then we'll come back after 15 minutes for First Mutual Holdings. The team is here for any further questions, should you have them. Thank you.